Looking from the outside, the U.S. housing market looks like the perfect scenario. Beautiful houses, quiet streets, and the promise of the American dream. But behind these perfect facades, a silent storm is freezing the market. And if you are thinking about buying or selling a property right now, the rules of the game have completely changed. Recently, I shared my real experience selling a property at this exact moment. And the diagnosis is clear. The stability that many economists preach is just an illusion. The big villain in this story goes by a name that scares any investor: mortgage interest rates. They rose aggressively, turning what used to be comfortable monthly payments into unpayable nightmares. The practical result: the number of active buyers is skyrocketing. Is plummeting at record speed. People were simply pushed out of the market by the cost of credit. Paralleled with this, here comes the big twist. Sellers are not budging. Instead of lowering prices to attract the few buyers left, they are simply taking their homes off the market. Anyone who locked in an old mortgage with low interest rates prefers to stay right where they are rather than selling and having to finance a new home at today's rates. This has created a double lock. To understand how we got here, we need to look at the numbers. For over a decade, Americans grew used to mortgage rates hovering around 3 to 4%. It was cheap money, and it fueled a massive buying frenzy. But almost overnight, the Federal Reserve spiked interest rates to combat inflation. Suddenly, those 3% rates shot up past 7%. For the average family, that single change added hundreds, sometimes thousands of dollars to their monthly housing bill. This triggered what economists call the lock-in effect. Imagine you own a home with a 3% mortgage. If you sell it today to buy a similar house, your new interest rate will double. You would end up paying way more money for the exact same lifestyle. So what do sellers do? Nothing. They stay put. This creates an unprecedented inventory starvation. There are almost no existing homes available for sale because nobody wants to give up their golden handcuffs. This is exactly why prices aren't crashing like they did in 2008. Back then, the market was flooded with foreclosures. Today, supply is so incredibly low that even with fewer buyers, the scarcity keeps prices artificially high. But this structural standoff cannot last forever. Something has to give. And the warning signs are already starting to show in the rental market and new construction sectors. Since everyday homeowners are refusing to sell, home builders have stepped in to fill the gap. Walk into any new construction site today, and you will see a completely different strategy playing out to attract desperate buyers. Big builder companies are doing something individual sellers cannot. They are buying down interest rates. They offer incentives where they artificially lower your mortgage rate to 5% or even 4% for the first few years just to get you to sign the contract. While this helps the new home sector, it leaves a massive portion of the population completely stranded. Those who cannot afford these new homes are forced into the rental market, driving competition there to absolute extremes. As a result, rent prices in major U.S. cities have stayed incredibly sticky. People are trapped in a loop. They cannot save enough for a down payment because their rent is too high, and they cannot buy because mortgage rates are pricing them out. This creates a pressure cooker environment. The demand for housing hasn't disappeared. It is just being compressed. And history shows us that whenever demand is artificially suppressed for too long, the correction is fierce.
Whenever people hear about a freezing housing market, their minds instantly jump to the great financial crash of 2008. The fear is real, and the trauma of millions losing their homes still lingers over the economy. But if you look at the actual data, what is happening today is almost the exact opposite of 2008. Back then, the crash was triggered by bad loans, subprime mortgages, and a massive oversupply of homes that nobody could afford. In 2008, the market was flooded with millions of foreclosed properties. Today, we are facing an inventory drought. Housing supply is sitting at historic lows, which acts as a safety net, keeping prices from sliding off a cliff.
Further, the credit quality of modern homeowners is incredibly high. Most people who bought homes in the last decade locked in fixed rates and underwent strict background checks. They aren't defaulting on their loans. So, if it's not a 2008-style crash, what is it? It is a gridlock, a standoff where buyers can't buy, sellers won't sell, and the entire system is running on fumes while waiting for the next macroeconomic trigger. When we talk about the U.S. housing market, it is easy to treat it as one single entity. But the reality is that the market is fragmenting heavily by region. What is true in New York is completely false in Florida or Texas. During the pandemic boom, states like Florida and Texas saw an unprecedented influx of remote workers. Prices skyrocketed. But now the tide is turning. These exact states are seeing a massive surge in new inventory, and homes are starting to sit on the market for months. In Florida, for instance, a secondary crisis is accelerating the freeze, skyrocketing home insurance costs. Combined with high mortgage rates, the cost of owning a home in these Sunbelt states has simply crossed the line of affordability for the locals. On the other side of the spectrum, the Northeast and Midwest markets remain incredibly tight. Cities with limited space for new construction are still seeing bidding wars because the inventory there didn't just drop, it completely vanished. This regional split means you can no longer just ask, is the market crashing? You have to ask, where is it crashing? Because while some zip codes are experiencing a slow bleeding of prices, others are still breaking records. So, where does all of this leave us? The U.S. housing market is stuck in a historic waiting game. Buyers are waiting for rates to drop. Sellers are waiting for prices to jump even higher. And the Federal Reserve is waiting for inflation to fully clear out. If you are looking for a sudden, massive collapse that brings prices down by 40% overnight, you will likely be disappointed. The structural lack of inventory is simply too strong of a floor to let prices freefall. Instead, what we are looking at is a multi-year stagnation. Prices will likely grind sideways or slightly down in overvalued markets, while the volume of sales stays incredibly low. It is a slow, silent correction rather than an explosive crash. The best move right now depends entirely on your personal liquidity. If you have cash and find a motivated seller willing to make concessions, you might find a deal. But if you are relying on heavy financing, rushing into this market could lock you into an expensive mistake. The rules of real estate have rewritten themselves, and patience is your biggest asset right now. If you want to stay ahead of these market shifts and protect your capital, make sure to hit the subscribe button, drop a comment with your thoughts below, and I'll see you in the next video.